Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMB in Manhattan, and I'd like to welcome you to our presentation today. Today we're going to be going over the capital scaling iron condor, which is a trade I developed some time ago. That is basically a challenge to the rest of the iron condor trading world, and something that I think you'll find of interest. So first of all, I think what we ought to do is to define what an iron condor is. And basically, an iron condor is, to options traders, a short call spread above the money and a short put spread below the money. To translate that into English, basically, we're selling a short put well below the money. We're selling a short call well above the money. And if the market expires between the strikes of the call and the put that we are short, we will be able to take home the full credit that we received when we sold those options. And we buy wings, what are called wings, on either side of those short options in order to protect us and to not get margined to a ridiculous level by our broker. Therefore, that is what is called an iron condor. And most people, when they adjust an iron condor, if you think about it, if you're short a call and the market starts rallying, that's bad for the call, all other things being equal. Most people, if the market begins to rally too heavily, for example, towards their call spread, they will roll that call spread out of the money, farther up out of the money. Well, that kind of roll, especially when the market's moving quickly, is very expensive. And when you're forced to do that in an iron condor, that adjustment, basically you're almost guaranteeing yourself a mediocre month for that condor. You won't make very much money because of the expensive cost of that adjustment. And the worst part is, ultimately, it ends up becoming unnecessary in most cases, because an iron condor initially is a very high probability trade, and if you just leave it alone and accept the risk of those days when one of those short options is in some kind of distress, typically you will be fine. But because most people are very careful about their risk management, and I'm not critical of that, they will adjust fairly early on in the trade, guaranteeing, other things being equal, a relatively boring or non-exciting month as far as returns for the iron condor. So here's an out-of-the-box idea. Instead of rolling away from trouble, why not add to your position when you're down money with the iron condor? Now, that's exactly the opposite of what most people do. But if you think about it, there's a logic to it. If you sold the iron condor for a credit of, let's say, $1, and then the iron condor expands to $1.50 in value, that means you're down money on the original trade because you're short that original dollar. But if you save some capital and you add to the iron condor during the course of the trade, then suddenly you go from being the buyer of something very expensive to the seller of something very expensive. And to some people, that makes sense. Now, there's a warning here. This trade, because we're basically doing the opposite of what most traders would do, is riskier and a little scarier than the other trades, and therefore you should trade this on very low capital if you're going to trade it at all, which I do not recommend unless you do lots of back testing and lots of paper trading before you use a very small amount of capital in a trade like this. But this is more to give you some ideas about how we teach options trading here at SMB. We like to think out of the box. So let's take an example. This March 2014 monthly expiration just ended, as you know. And suppose you went about 2 months back into January, as typical iron condor traders will do. And we go ahead and we throw on this iron condor in the Russell 2000 with strikes of 1260 and 1060. So the market on this particular day was at about 1172, and therefore we're about roughly 100 points from the market on either side. That would be a typical entry for an iron condor. Now let's hold back 3/4 of our capital, only put in 25% of our capital. Let's say we're building a 100 lot here, so we've got a 25 lot on. Now let's go to, and as you can see, we've got a very wide, what we call landing zone for the options trade here. As long as we end up between 1060 and 1260, we can take our credit back if we do not adjust the trade at all. Now, a week later, we're going to just go ahead and add to the trade. The trade is down money, as you can see, and therefore, if we add another 25 lots a week later, that means that the trade, that we're getting paid more money for that second tranche of capital that we're adding. So it sort of makes sense. Instead of rolling out of trouble, let's add to our capital level and just get paid a little bit more for it. Third week, same situation. The capital is added to the trade when we're down money on the trade, and now at this point we're down a pretty decent amount of money because the market has sold off quite a bit. So that means we're really going to get paid very well for that third tranche of Iron Condor that we're adding at the exact same strikes. And then finally, fourth week, we do the same thing. The market came back a little bit, but we're still getting an excellent credit for just not moving. Putting the Iron Condor up, allowing the high probabilities of an Iron Condor statistically, allowing those probabilities to work in our favor. So now we've taken 4 separate weeks, we've added 4 separate tranches of capital, and let's take a look at what happened in the next week. In the 5th week of the trade, the market rallied. That shouldn't be a big surprise to everyone. This is a very bullish market. Every time the market sells off, some bulls come in and buy the dip. So first of all, just from a technical analysis standpoint, you could sort of figure something like this was going to happen, and it played in perfectly to this particular month's example of this trade. And all of a sudden, the trade bloomed, and we're up, very big money just 1 week later. Had we expired the trade this past week when the monthly March expiration finally ended, then you would see that you would have made a very, very attractive return for the strategy given the way that we traded it. And so what happened was, instead of overreacting, had we reacted when the market sold off and rolled out of trouble, that would have been a safe thing to do, but it would have virtually guaranteed a very boring month in terms of returns for this Iron Condor. Instead, we got a very nice return for the Iron Condor simply by adding capital where other people were basically subtracting capital. We're adding capital, and it worked out rather well in this particular month. Will this work out always? Of course not. Will you have losses with this strategy? Absolutely. But it is a strategy which brings the probabilities of options trading into your favor, as opposed to possibly overreacting through adjustments, which ultimately prove unnecessary and very expensive, making the trades at best mediocre. So the moral of the story is, use probabilities in your favor in options trading when you can. The over-adjustment of trades can sometimes be a mistake. It's a very careful thing to do. I support it and teach it in most cases. But this is an example of a strategy where you do the exact opposite, and many times it will work out well for you as well. Keeping some powder dry in your options trades for later adjustments is a very good idea. At SMB, we talk about a concept called planned capital, where we keep powder dry at the beginning of every trade in order to have a planned adjustment strategy in each case, and you will find that you will be able to be a more successful options trader when you plan your capital more carefully. So with that, I'd like to thank you for watching this presentation, and if you have any questions, go ahead and just send me an email at sfreudberg@smbcap.com, and I'd be delighted to answer those questions. Thanks very much. Have a great week. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.